Shall we start? I think my chairperson is missing, but until the time that he does his duties in making sure the IBBI chairperson is safely seen to his car, can I request the next speaker to come up? This is Prasenjit Chakrabarti, and I happen to be discussant of it. Yes. All right. Prasenjit, so much. Actually, we should just leave it as Jyoti. If you can, that would be great,
So
because I'm carrying other stuff in my bag. Thank you.
thank you and good afternoon. I am Prasenjit Chakrabarti and doctoral student in finance and accounting area. I am Indore. So the title of my paper is Commonality in Volatility Risk Premium. To start with, I just want to show you a plot that is a Nifty plot of the Nifty implied volatility vis-a-vis Nifty realized volatility for a certain period of time. Okay. So if you see the plot closely, then you would see that the implied volatility of the Nifty on average is overestimating the realized volatility. So as a student of finance, what I can do, I can just sell the implied volatility and just buy back the realized volatility, and I can earn economic profit. So the graph over here is nothing but the spread between these two volatilities, and even in this particular graph you can see on average this particular series is coming out to be positive. So in literature we call it volatility risk premium. So traditionally the spread between the implied volatility and the expected volatility is termed as the volatility risk premium. And this is not that it is only known to the academic world, but it is also well practiced in the industry. So if you see closely the recent industry reports, all they are talking about what are the different benefits of systematically selling volatility. So this is what we know about the VRP, and most of the academic literature, they studied the VRP of the index or the index options. So what is new in this particular paper? Here we have analyzed the VRP of 44 individual stocks, and what we have found that 35 individual stocks show on an average positive VRP. So with looking at this particular thing, we asked whether there is any kind of relationship between the market VRP vis-a-vis the individual stock VRP. Moreover, we have also seen that there is a large cross-sectional variation of the individual stock VRP. So to understand whether there is any kind of relationship between the market VRP and the individual stock VRP, we got a clue from the Card and Wu paper, who said or who presented the evidence that possibly market only prices systematic component of the volatility risk in the stock market portfolio. So with that clue, we asked, in this particular paper, we asked the question whether market prices systematic component of the volatility risk, or in other words, does commonality in volatility risk exist or not? Okay. So if market prices the systematic component of the volatility risk, that means that we would have the implications of the option pricing front, and moreover we have implications on the asset pricing, which basically deal with the uncertainty in return volatility. Okay. So now the question is why the commonality may exist. So there can be two schools of thought. The first is from the traditional risk sharing properties of derivatives market. So according to this school of thought, some researchers say that option buyers actually pay premium to the option writers. So it is much more driven by the option demand. So what we can infer that under commonality volatility shocks, the option buyers pay premium to option writers to hedge risk for the market as well as for the individual stocks. But what we are arguing in this particular paper, that it is basically the information role of the derivatives market rather than the traditional risk sharing properties. So what we are arguing that as noted by Tarun Kodia, this is a seminal paper which is on commonality of liquidity, but it states that the trading activity exhibits correlated trading pattern in response to the market-wide volatility shocks. So, in response to this market-wide volatility shocks, the volatility informed traders who know that what is going to happen about the future volatility, they take positions on the options market. And the liquidity suppliers, who on the other hand, they can observe the what amount of volatility demand is coming out of the options order flow. So if they can observe the options order flow coming out of, what is the net volatility demand of the options order flow, so they will try to price the option in such a way so that the implied volatility of the options exceeds the realized volatility rate. So this particular pricing mechanism by which the liquidity suppliers price such that the implied volatility exceeds the realized volatility, we call it volatility marker process. And so this particular spread actually comes out as a VRP in the market. So so over here what we are arguing that under common market-wide volatility shocks, the volatility markup is implemented for the individual stock options as well as for the index options. Okay. So the objective of this particular paper, the first objective is to understand the extent to which the commonality relationship exists between the individual stock VRP and the market VRP. And the second objective of this particular paper is to understand how robust this commonality relationship with the explanation of the volatility markup hypothesis, just that I have explained right now. So coming to the methodology, I measure the market VRP with as the difference between the model free implied volatility minus the expected value of the realized volatility. So coming to the model free implied volatility of the market, I have just taken the India VIX level as a measure of the model free implied volatility. Coming out to the stock VRP, I calculated the model free implied volatility of this particular stock by the same methodology used by NSE to calculate the India VIX. So coming to the realized volatility, we need to the computation methodology of realized volatility is the scaled TSRV, that means scaled two-scale realized volatility measure. Now, if you see, we need to actually project the realized volatility for next 30 days. So to project the realized volatility for next 30 days, because this VRP actually is the difference between the model free implied volatility minus the projected realized volatility for next 30 days. So we followed Jindal and Vipul paper, which is for the Indian market, where it is mentioned that the random walk model best that dominates the other kind of model in forecasting the realized volatility for next 30 days. So this is our main regression equation. Over here what we have done, we have regressed the stock VRP with that of the market VRP, and we also included some market specific and the stock specific characteristics, which I will tell you later on. So this above estimation is done by the pooled regression, and UST statistics are reported. So over here the stock VRP represents the daily measure of the VRP of stock J, and the market VRP represents the daily measure of the market VRP. Now, if our hypothesis about the commonality is true, then we expect that for some of the i's, this slope coefficient of the market VRP will come out to be positive and significant. Okay. So coming to the market specific and the stock specific characteristics, first of all, I control for the market volatility level, and the intuition is something like this: when the volatility level is high, this particular volatility marker process would yield a lower VRP. So if this particular intuition is true, then we would see some kind of negative relationship between the stock VRP and that of the market volatility level. So another market specific factor is the change of the market volatility, and the intuition is something like this, that the liquidity suppliers set higher prices, will try to set higher implied volatility for the recent high change in the volatility. Okay. So coming to the stock specific factors, I have also controlled for the stock volatility level and the change of the stock volatility for the same reason as mentioned above. And apart from that, I have also controlled for the stock size, because it is commonly believed that larger the size of the firm, lesser the information asymmetry. And so for those firms which has got lesser information asymmetry, the liquidity surplus will tend to set the lower volatility markup process and would yield lower stock VRP level. So for the same, we have also controlled for the stock liquidity. The reason is same, higher the liquidity of the firm, lesser the information asymmetry, and we expect that the liquidity surplus will tend to set lower volatility markup. And the last stock specific characteristics is the option demand. And for option demand, we have taken the stock put open interest, because previous studies told that it is a natural proxy to put option demand. It's a natural proxy for the option demand. So the intuition is something like that, that whenever the option demand is high, this liquidity surplus will tend to price the options higher. So this is the result. So in the first, I have included only the market specific factors. So over here we can see for all the specification of this particular model, the market VRP coefficient is coming out to be positive and significant. Coming to the market volatility level and the change of market volatility, all the coefficients are coming out to be negatively significant at 1% level. The change of the market volatility is coming out to be positively significant at 1% level. Now, when we included the stock specific characteristics into the commonality relationship, we have seen for all the specifications, the commonality relationship does not change and all the coefficients are coming out to be positively significant. Coming to the stock volatility level and the recent change of the stock volatility, they are coming to be negatively significant and positively significant as expected. Coming to the stock size, it is also showing the negative significant coefficients, and we also included the quadratic term of the stock size. Just so it might be the case that there can be some kind of non-linear relationship that may exist, and we have seen that the non-linear relationship exists, and it is also coming out to be positively significant. Okay, and for the stock liquidity, the coefficients are consistently negative, though not significant, except the last specification. Coming to the option demand, they are also coming out to be positive and significant as expected. When we run the regression for taking the market specific factors and the stock specific factors, the commonality relationship still holds without any change, and all the other factors are coming out as expected. So with this, we are just concluding this particular study that it presents the evidence that the market prices systematic component of the volatility risk heavily for the individual stocks and the market as a whole, or in other words, you may say that commonality in volatility risk exists and the relationship is robust and statistically significant. And moreover, this particular relationship is, this particular result shows that they are robust and consistent with the volatility markup hypothesis, which we have assumed. So that's all. Thank you.
Thank you. Okay, so I'm the discussant, the chair. I'm the discussant, I'll go up. Okay, so thank you, that's fine. I don't think I'll take very long in discussing this paper. It's a reasonably nice paper with a new idea that I hadn't really seen developed a lot earlier. This is, and Kiran has had me as a discussant on earlier papers before, so perhaps some of my responses are things that you've heard for the last 25 years, because some things don't change, right? Okay, so what is this paper about? And thank you for having sent it in, because it kind of updated me on some of the questions that are being asked. The question that the paper asks is there commonality across stocks when you look at their volatility risk premium? And I thought the interesting features of the paper were two. It looks like a new interesting measure, which captures the risk of volatility or the uncertainty about volatility using the gap between the realized volatility in the market versus what the implied volatility is, right? And this captures in a certain sense our uncertainty about what the volatility of the stock is. And of course, the paper uses proprietary data from the National Stock Exchange. I think it's for a year of data. And so these I thought were interesting new features about the paper. And now I wanted to just touch upon understanding more what is meant by volatility risk premium. And the question is this really a new idea? And I know that the motivation for the paper in the introduction says it starts off on a very well-developed literature base, which is commonality in liquidity, that market liquidity has got some features where commonality of liquidity across stocks is something that a lot of papers have been done. There are other papers on commonality in volatility, and this paper seems to take it one step forward, which is commonality in volatility. Now, when I did a literature review, there weren't that many papers on commonality in volatility risk premium, but there are several papers in volatility, commonality in volatility itself. So for instance, there's a 2014 paper, and it motivates the idea really nicely, which is to say that there are market spillovers, or when a market itself is more volatile, then there are spillovers to stocks. And in fact, there's a recent paper, I think, from the NBER that says that actually if you look at emerging economies versus developed economies, some of the volatility commonality that you see in stocks is largely driven by the market index volatility as compared with stock-specific volatility. So I'm actually curious to see how this paper is motivated, because when I read the introduction, other than saying that we are taking forward an idea of creating or testing for commonality in one observed market variable about stocks, there didn't seem to be a story about why this is interesting, either in terms of explaining predictability about volatility itself of the stock, or in terms of saying how this matters to pricing. Although both are alluded to, there isn't any explicit story saying this is how it matters. So the question that I ask myself is, how is this paper on volatility risk premium different from the existing literature that we see on commonality in volatility itself? Because that seems to be looking at saying how much of the volatility across stocks is common with respect to the market vol versus how much is it specific to the stock itself. And they do similar sorts of exercises saying how does it link to size, how does it link to volatility. So it seems to be asking similar questions, and I'm not sure I understand how this particular variable, although I think it's a very interesting variable, I don't understand how it plays well in terms of helping us understand either stock level volatility better or price premiums better. So this is my gap of understanding, and this is something that I struggled with. So my reading of the paper is that the measure itself is interesting. It captures an information shock in the expected versus realized returns of a stock. And this shock is coming from unanticipated market volatility. So the overall market is moving, there's an unanticipated shock, there's some kind of a transmission mechanism to unanticipated risk of the stock itself, and that's how this paper is motivating itself. So here are the questions that immediately came to my mind, right? So is this a model that helps us predict stock volatility better? Is it a model about expected premium that we pay in terms of a price for the stock for volatility risk? I'm not sure that either of these are actually developed in the paper or even addressed, right? The next is, this is a model that market volatility risk premium, that is the risk premium of the market index, is an early warning indicator of an expected increase, or an increase that we should see in the stock level volatility risk. Right? So is that what the model is? Is it a prediction model? If it is a prediction model, then traditionally I always think of prediction models that translate into some kind of a trading strategy. In that case, if it is supposed to be a prediction model, then how does it translate into a trading strategy? I can see that there are two markets here. One is the market for options, where you can directly trade the volatility of the stock. Or is it the stock itself, the underlying spot itself? Does it tell us something about the premium? Is it going to give us an investment strategy, which is a long-term buy and hold strategy, or is it something that translates into a trading strategy? So for me, when I read this paper, I could take the choice of saying it's a technical exercise on a new variable. in which case I have some problems, or it is something that tells us something more about asset pricing or volatility prediction at the stock level. So these were my list of questions, and as I said, Kiran and I have been meeting each other in multiple conferences over the last 3 decades, and I'm sure that he finds that some of these questions are common across a lot of the work we've done together. Kiran, nothing has changed. Okay, so here are my suggestions on the work that I can think of in terms of strengthening this paper, right? So it really requires better motivation and rationale to explain where this paper fits. As I said, there seem to be these multiple blocks that are already out there. There is returns, there is liquidity of prices, there is a risk and volatility of returns, and now you have a volatility risk premium. So how do we connect all of these pieces together to just even link up the 3 pieces, right? So we've been debating internally that when we want to look at measures of market quality, exactly what are we asking about, right? This, in an emerging economy where regulation is always asking about how to make markets better, the question is, how do we measure the market quality right now? Then we do regulation or law change, and then we see how does market quality improve or actually has it worsened. So when we look at all of these measures, clearly these are things that markets give us. There is a central thing which is called the price. Today we also get to see the limit order book, so we get to see some independent measure of liquidity. Then we have options market that gives us a sense of the risk premium, the volatility risk premium as well. So how do all of these pieces fit together? If you can put together a story that weaves all of it, it will better motivate this work, because right now it feels a bit like an orphan child that doesn't have that much support. I think that it could do with some more literature review. I don't know whether it fits in your story building. As I said, I see of this as a paper which is actually taking one piece out of an interlinked set of measures, and perhaps having literature review that looks at all of the other measures also to a certain extent could help, right? So that's my first set. On the statistical test, right, and there I thought I would like to probably point out that this is something that looks like a time series measure, right? For every stock, you've got a time series of your volatility risk premium. The first thing that I would think that you ought to do, and I know that you've done the summary statistics of saying mean and the structure of the distribution of the numbers for every stock, or the sample of stocks, but we need a better analysis of what it looks like as a dynamic time series itself. Right? So you've created this regression equation where you've put in the market volatility risk premium, both lagged and lead variables, but you haven't actually told us what is the inherent dynamics of the stock volatility risk premium itself. Is it something which is I0? Is it closer to I1? Is there time series dynamics in it? Because without solving that, to put all the other time series variables that you have put into the regression, you could be running into all kinds of spurious results. Right? So my suggestion to you is the first thing that you should do is thoroughly analyze and understand the animal that you're measuring, because I think that's interesting. That's not something that any of us have really seen a big literature on. And if there is existing literature about this measure for, say, better developed markets where you would expect a lot less information asymmetry when you trade stocks, say in the US on the options market, you think that there's a lot more governance and better structure, whereas here it is not so much. Then the question is, let's understand that versus this, right? What are the kind of models that we expect for a volatility risk premium? So I think that you need better analysis of the dynamics of the volatility risk premium. And then, of course, this is something that Kiran will have seen time and again. Once you have such a time series model and it looks like a prediction model, then of course we don't only work with in-sample regression and estimations. We do need some effort at an out-of-sample estimation. How well does it behave when you keep a sample out and you do a prediction? This, I think, is dying. If it is a prediction model, it's just dying for a prediction framework, right? So as I said, if this is prediction, then how does it actually play out in either an investment or a trading strategy? So once you set up that prediction framework, of course, I think the next natural would be to say, my model works and this commonality is true because I'm getting great out-of-sample prediction. So I think that these are the things that I would leave you with. I'm thanking you twice because there are 2 co-authors, and that's it. Thank you. Okay, Chairman.
I think he has got a question.
Yes.
Ajay, I think there were questions for you.
Yes, Pradeep. Yes, Pradeep. I think this is it's an interesting area, the area of the volatility risk premium. And while the results per se are interesting, I think more interesting is to try and understand what are the reasons for those results. And more interesting is to try and understand among the various possibilities of hypothesis that exist for the volatility risk premium, which of them is driving what you're specifically looking for. And in this case, what you're looking for specifically is the commonality and the things which drive together. So, for example, among the things which have been suggested for the volatility risk premium is the fact that there is a very high risk aversion to extreme events, and that risk aversion to extreme events is not captured by normal normal sort of methods. Now, there is also the so that I don't know how you will test that, how you would be able to sort of link that to greater commonality in some form. In maybe looking at periods where there is greater expectation of extreme events relative to other periods, or whatever. The other is the variation in risk aversion in the economy has to be correlated across stocks. So if there is an increase in the risk aversion with which you approach the pricing of one particular stock, if there is a variation across time, that variation across time would be correlated across stocks. Now, you have the data. It's quite easy to, for example, estimate the risk aversion implied by option prices using the kind of method which was used in Aitsalia paper in 2001 Econometrics, or the Robert Bliss paper in JF in 2004. So if one looks at the risk aversion implied at different times, you may have to use a longer time series. I don't remember what is the length of time series you used. But if you might have to do the longer time series in order to capture tangible variation in risk aversion, or use some periods which have a major reason for a change in risk aversion around the financial crisis or something like that. If you can sort of link that co-movement can show that the co-movement of risk aversion drives the other co-movement, then that's a possibility. And there are other hypotheses as well for volatility risk premium. You've used the model-free estimate, which is good, but I'm not sure whether it completely captures jump models and so on and so forth. So, yeah.
I want to just build on Pradeep's suggestion, which is to see whether you can better tease out the drivers of your results. So it looks like what you have in mind is some kind of a unexpected volatility shock. Informed traders get excited about it. They send their order flow that results in certain price impact, and then you have this commonality across individual stocks at the market-wide level. But market-wide volatility shocks can also impact the supply of liquidity, because inventory risk might go up. It's tied to volatility from a theoretical perspective. So I was wondering whether you can look at certain types of news events, like macroeconomic news events. Maybe you have some unemployment or some other macro news that comes out, and maybe try to tease that out. The other variable that may be of interest is overall market-wide trading activity, because that's tied to inventory risk. Market makers hate the idea that they would take on a position and they have to hold it for a while. And as trading activity declines, that risk goes up. So market-wide trading activity might again be a common market-wide signal that might affect the inventory risk. So you may want to think about some sort of news events that might help you at least comment something about what might be the mechanism.
Here, what I'm getting at is, the variance risk premium literature also indicates how much of that is actually coming from, there's a bit of credit risk to it. What I'm getting at is the size of the firm matters, the leverage of the firm matters, and so on. Obviously, that's not your focus. I'm sort of saying part 2 of your paper, next version of this paper. There are quite a number of JFK papers, sort of look at the time dimension that you're looking at. But the cross-section is also very interesting. And I think, so firm level variables do matter there. So, and I think that could be an interesting, I can say more about it, but interesting way to link credit risk and so on into the variance risk premium, into part 2 of your paper. Thanks.
Okay, would the authors be able to respond quickly then?
Yeah, sure. So, first initially, thank you, Susan, for giving the comments. Of course, the paper straight away looks at, as Susan said, it's a straight paper to examine the presence of commonality in volatility risk premium. And because it's a first of the kind of paper which comes up with the volatility risk premium, we thought that first one is to just see that whether there is a commonality exists or not. And of course, definitely the next set of questions will come up as, in case if the commonality and volatility risk premium exists, what next? So why do we observe this kind of commonality? What are the sources of commonality in liquidity? All those other issues will come up. But as of now, yes, we have not thought about what are the sources of commonality in liquidity. And one possible solution is, and one possible linkage is, yes, there is a investment trading strategy that can be easily built in up, because already the practitioners will are into the market saying about investment trading strategies. So we see there. And also from the statistical analysis or the dynamics of the process, yes, all these stock VRPs, stock volatility risk premiums, or I0 series, both at the index level as well as at the individual stock level. And with reference to Professor Pradeep's view about the sources of the commonality in liquidity, it's like, yes, we can look at some of the extreme volatility shocks related with any of the, related with the like elections or maybe the crisis, financial crisis and such kind of things. But because we have only 1.5 year of time period, so we don't have the enough data on events and other ways as well. Even the same thing holds for the in-sample and out-of-sample kinds of tests, because we have just 1.5 year, we just start off. But of course, we can do it like 1 month or 2 months this way. And
so I think it depends upon your setting up a trading strategy. I mean,
Yeah.
that would make more sense to me. But if you're convinced that it's I0, number one, we're not sure whether it has some persistence at all. So there could be an AR1 even though it's I0.
Mm.
But that has to be done.
Yeah.
And second thing is, it's okay to take 1.5 years and keep one period out and still do an out of sample.
Yeah,
right?
yeah,
It's
yeah.
better than
Yeah,
not, I think.
yeah, and that's true. Yeah. So that's.
No, I'm just on time management.
Oh, okay. And the other is with Professor Kumar Venkatraman's issue about controlling for the market size or market trading activity variables. Yes, we have some sort of controls on the market activity variables that's been taken care of. And yeah, with Professor Madhu's comment about the credit risk or firm's leverage and other firm-specific variables, I think so we have some amount of firm-specific variables in terms of both the derivatives markets as well as the spot markets that will account to an extent. Because this leverage and other this kind of variables will come at quarterly frequency and such kind of things, whereas this is the daily level, so we will not be able to do it. Yeah, that's that. Anyway. Yeah.
Okay,
Thank
thank you. Can we please move on to the next paper?
Thank you.